Welcome to the February issue of Trading Japan's Energy Markets, sponsored by my good friends at JPX Tocom. I just returned from 10 days in Japan for my bi-monthly visit. Very interesting time there. Met with a number of retailers, also a few corporates, a little bit of time with Tocom as usual, always enjoyable. So a couple of things really highlighted some of the activities that I think will impact futures markets in a positive way. First of all, we're seeing softening of LNG and power prices down about 10% in January, combination of global markets calming down, especially for LNG a bit, and weather is not as severe in Japan as expected. Although a couple of days I was there, my coat wasn't quite enough, but that was just 2 days, no big deal. So I think that will help, primarily because with the prices constantly going up, it's challenging for corporates and the large customers to lock in for like a year or even a month because the prices are so high. So when it softens, all of a sudden you see more buying activity by the companies that say, let's lock in at a better price than it was a month ago. That will help hedging activity, I believe. The second thing, in talking to some of the larger retailers, we're seeing the emergence of certainly a forward curve. Tocom's been publishing a forward curve based on their models, but it's a monthly curve, and it's a good indicator. It was never meant to be used on a day-to-day basis for pricing pricing end-use customers. But we're seeing the emergence of a 30-minute, 2-year forward curve. It's actually a project we've been working on as well. And the reason for 30 minutes is because the meter data comes in 30 minutes. So the load profile from a corporate or any customer for that matter over a prior year is in 30-minute increments. So you want to price it in 30-minute increments or hedge it that way going forward. So it's very early, and there's a few companies using that tool, and then of course pulling in demand forecasts and pulling in load data. So what we're seeing in, like, for example, the U.S. markets, where retailers can price a corporate customer using that kind of a model with forward curves. For the smaller customers, in the U.S. they use a matrix pricing, which can be done in like a matter of minutes, and then drives hedging activity as well. And then for more custom, larger customers, that can be done, with models, an hour or two, sometimes maybe a whole day. Where in Japan that hasn't happened yet. So we're seeing the adoption of those tools, especially the 30-minute, 2-year forward curve, which will also lead, I believe, to more hedging, because once you take those positions with the demand side, you of course want to offset that on the supply side. And obviously JPX itself, the spot market, goes out a day, so it's not going to cover a year or two. So that's going to be good news, I think, help drive the Tocom volumes and more liquidity, especially in the back months, where it's, as usual, a little bit thin in the second year. But that's all good news, and it's all very positive developments for the Japan market. The last item for today's video is met with several renewable developers and a couple of very large corporates. These are 50 megawatt and up, but also was reviewing the results from our December survey of these extra high voltage 2 megawatt and up customers. And 29% of those customers have plans in the future to do a PPA offsite, as in not on the rooftop. So that's driving a whole new set of behaviors on how to price that, how to hedge that over a 15 to 20 year period. What's the market makers in the middle do as far as between the developer and the customer and the different components that takes. So all of this, I think, bodes well for driving even more futures and over-the-counter market activity in Japan So I expect over the coming months and year or two, that will drive even more volume. So those are my observations from this last trip. Hopefully that's of some interest and help. Thank you for watching.